If this Google position fails, I lose 11,000 US dollars. No margin call, no hedging it away, no, I'll just make it back on the next trade. That money is absolutely, utterly gone. And I accepted that before I placed the trade because this wasn't a bet on price, momentum, or headlines. It was a bet on time and on whether Google as a business will still matter years from now. In this video, I want to walk through why I'm willing to be wrong on Google and what would actually have to break for this trade to fail, and why this kind of risk is fundamentally different from what most people think of when they hear the word options. There's a massive disconnect in how most people think about investing. They think risk means volatility, and they think that being wrong means losing money quickly, and they think that success means being right fast. And that mindset creates behavior that looks active, intelligent, and confident, but usually leads to poor outcomes over time. And this Google trade sits on the totally opposite side of the spectrum. It's slow, it's boring, and it requires being comfortable when uncertainties stretch for long periods of time. Most people do not lose money because they picked bad companies. They lose money because they couldn't sit still long enough for good businesses to work. And that's the lens this trade was made through. Before going any further, context definitely matters. My portfolio today sits well into the mid six figures, and the majority of it is intentionally boring by design. This is index funds, long-term equity positions, cash reserves, and this Google position is not the core of my strategy. It's a layer added on top of a base that doesn't depend on this being right. If this trade fails, my plan does not change, my behavior doesn't change, and my risk profile doesn't change as well. And that is absolutely intentional. And when you see people blow up accounts, it's rarely because they were wrong once. It's because being wrong forced them to change their behavior. And this trade was sized so that doesn't happen. Okay, let's talk about what this position actually is. I didn't buy short-term dated options. I didn't buy weeklies. I didn't buy something that requires precision and timing. I bought leaps. It is a long-dated call options, and that distinction is everything. Leaps shift the question from, will this stock move soon, to, will this business still be relevant years from now? Instead of fighting time decay, you're partnering with time. And I don't need Google to surprise anyone next quarter. I don't need an earnings beat. I don't need hype. I need the business to continue existing, adapting, and monetizing attention over a long horizon. And that's a very, very different bet. So here is the entire thesis of this trade, stripped down to one sentence, okay? It's Google doesn't need to win headlines to win economically. And most of the fear around Google today comes from narratives, especially around AI. Who's ahead? Who shipped it first? Who demoed the flashiest product? But narratives do not generate cash flow. Distribution does. Google controls global search behavior, the largest video platform on earth, mobile operating systems, advertising infrastructure across the internet. And that's not a product portfolio, that's attention infrastructure. Infrastructure doesn't disappear because a competitor has a better demo. It erodes slowly, if it erodes at all. And that's where time becomes your ally instead of your enemy. Okay, the market, it tends to oversimplify new technology cycles. With AI, the simplified story became whoever builds the best model will win. And that's not how money has historically been in tech, right? The winners almost always are the companies that control distribution, own the customer relationship, and can monetize at scale. And Google already owns those layers. AI integrated into search, ads, productivity, and cloud infrastructure is far more valuable than standalone tools that still need users' trust and monetization. Google doesn't need to dominate AI in isolation. It needs to embed intelligence into systems people already use. That's a much quieter and much more durable advantage. One of the most underappreciated aspects of this trade is Google's cash flow. Free cash flow changes the nature of risk entirely. It allows buybacks during periods of weakness, it continued reinvestment without dilution, strategic mistakes without exponential damage, and this is not a company one bad decision away from irrelevance. Time favors companies that can fund their own evolution. And when you're buying time, which leaps are, that matters more than the short-term performance. Here's the next point. This is where people often misinterpret intent. I didn't choose options because I wanted leverage. I chose them because I wanted clarity. With this structure that I have in place, my maximum loss is defined up front. There's no margin, no forced liquidation, and there's no emotional spiral. If I bought shares and the stock dips significantly, I'd have to decide, do I add? Do I cut? Do I wait? With leaps, the decision tree is much, much more simple. It's I paid for time, and now I either let time work or I accept the cost. And the simplicity is a feature, not a bug. Okay, position sizing is where discipline actually shows up. I didn't ask, what's the upside? What's the maximum loss I can tolerate without changing the behavior? $11,000 is meaningful enough to matter if I'm right, and small enough that if I'm wrong, it doesn't alter my strategy. If a position causes you to check it constantly, it's too big. It will affect your sleep if it's too big, right? And this one doesn't. Okay, I'm not calling a bottom. I'm not predicting a breakdown. What I am doing is recognizing when expectations are low and narratives are stale. Google isn't exciting right now. The upside isn't being marketed aggressively. Concerns are widely known. It reached all-time highs, right? And that's usually where long-term opportunity hides. This is about skewed risk and reward, not certainty. This is the most important section right here, okay? Make sure you're listening. Here's what would truly make this trade go wrong. It's a permanent loss of Google's distribution advantage, structural damage to advertising economics, regulation that materially impairs long-term cash flow, and strategic failure that capital cannot fix. Not volatility, not missed quarters, not sentiment shifts. If the business breaks, I'm wrong. If the stock moves around, that's noise. Okay, this trade doesn't require perfection. It doesn't require hype. It doesn't require speed. It requires relevance, survival, and time. Most people blow themselves up chasing fast outcomes, and I'm deliberately choosing slowness. And just a reminder, this isn't for everyone. It requires patience, emotional control, and comfort with being early and quiet. And if you need constant feedback, this will feel mad uncomfortable, and that discomfort is the price of positioning. I'm not trying to be right fast. I'm trying to position early with risk defined and time on my side. If it works, compounds quietly, and if it doesn't, I move on intact, and that is the bet. Thank you so much for your time. If you're still watching, just know that I'm rooting for you. Make sure you hit that like button, hit that sub button, and we got videos coming out every single week. I appreciate your time. Thank you so much. Have a great rest of your day. Pappy Cam, and I'm out. Peace.